Hello and welcome to this fresh new edition of All About Your Company. We're going to be talking about Raymond Realty today. Why do I say this? Because we've spoken to at least 3 guests this morning, all 3 of who have flagged that the real estate stocks will well be in focus in the run-up to the budget. And therefore, one of those will be Raymond Realty. I'll talk a little bit about the background of everything that we spoke about. So Kunal Bothra, for one, said that technical indicators seem to be indicating that real estate could well be a sector which will be in focus all the way through February, running up to the budget. We also spoke with another couple of fundamental guests who seem to believe that realty may be at the cusp of bottoming. And therefore, we'll try to analyze this better and get your perspective on what Raymond Realty is up to within that real estate pack. Now, first thing I want to know is with regard to execution and approval timelines. Plenty of projects that they are executing at one go where Raymond Realty is concerned. And I'd want to know basically as to what the timelines for that execution could well be, because cash flows as well as the profit and loss account will largely depend on the execution that plays out. The second one is the finishing or the launch timelines to finish. How long does it take? Because there are plenty of launches which are scheduled for the next 6 to 9 months itself. We'll take a look at those numbers and you'll see why I want to understand as to when the timelines for finishing some of these projects are going to shape up. The third piece is with regard to sales traction and pricing in the Mumbai market, which is where Raymond Realty operates. That is crucial because that will determine whether the company can continue to scale and as it continues to grow and hit fresh launches, whether they can continue to get traction for all of the launches that they are looking at. The fourth piece is with regard to margins, and I want to, one, understand whether margins can hit the 20% number. Management has sounded very resilient on past con calls, speaking about that 20% number, but we're currently in around the 12 to 15% band. So we are a far cry away from 20. Now trying to understand how the management gets there. Will it be, will the margins fluctuate immensely as the years roll by, or will it be a steady rise towards 20, a linear rise towards 20? The fifth piece is with regard to net cash, debt, and working capital positioning. This is all balance sheet related. I want to understand how they've guided for a 1:1 debt. At the moment, debt is not as much of a concern, but if debt were to inch up and get optimized, I'd want to also understand how cost of funds are shaping up. But capital allocation, positioning, as well as net cash and debt, those are some of the parameters we'll want to understand better. The last piece is with regard to Pune. They're looking to launch in Pune as well. What are the timelines for that? What's the thought process? How will they go about doing that? Really, essentially, is what will also drive us to understanding as to what the plans for Pune are. Now let's talk about Raymond Realty. It's obviously the demerged arm of Raymond Limited, and therefore we'll have very, very limited data sets in terms of the metrics that we discussed. But first, let's talk about the company. It's currently based out of Mumbai and Thane rather. So the larger Mumbai region. It owns land banks in Mumbai, which is mainly based out of Thane. It has a very large land bank there. 25,000 crore is the gross development value of that land bank, so extremely large. 100 acres is the size of that land bank. It started from that point, and then thereafter, it did its first development in 2019, thereafter in 2021, and then they've added projects in 2023. Thereafter, they have started doing JDAs, which is joint development agreements. And with joint development agreement, what comes in is that they will obviously be responsible for the branding and the like, but there will be a joint developer which optimizes the capital positioning of the company. So it makes the company an asset light model, which is positive, of course, from a shareholder standpoint. And there will be an increase in terms of the JDAs that they do versus the past. So currently, the JDAs that they have launched is approximately, or rather that they've planned is approximately 14,000 crore in terms of GDV. The balance 25,000 crore is from the development value of the Thane land bank. But that will likely change going forward. there will be a larger proportion of JDAs that they do, which is capital efficient as well. Some of those details is something you can see on your screen already. That is, of course, with regard to Thane and the JDAs that they've signed, the 6 JDA projects that they've signed. I want to talk about the type of products that they do. It was on your screen briefly, but let's talk a little bit about that. They are in 3 product categories. One is aspirational, which is 10x. Then is premium, which is the address by GS, that's the brand name. And the last is obviously luxury, which is Invictus by GS. So you've got those 3 brands under which they sell their products currently. In terms of the geography of sales, we've spoken about this a bit, but let me give you better color. Thane is obviously the predominant part because they already have land banks there. Mahim, Vadala, Sion, BKC and Bandra are just some of the other places where they have where they are likely to have a presence or already have a presence. I'll talk about which of these projects are completed, where are we in terms of the stage in just a bit. But first, let's talk about the Thane land bank in particular. The total revenue potential we spoke about is 40,000 crore. 100-acre land bank is sitting out of Thane. 55 acres of that is undergoing development. 45 acres is still upcoming, so some time away. 6 JDA projects have been signed. We've spoken about those projects. In terms of upcoming launches, Mahim, there are 2 projects which are likely to be launched. Vadala, Sion, BKC, Bandra, and Thane also there are 2 projects to be launched. Now let's talk about where the financial position of the company is today, because the base effect will completely rule out any of the CAGR numbers that I put out there. So where are we in terms of the top line today? This is FY25 numbers, viewers. The 9-month FY26 numbers are far higher. So we'll talk about that as well. You look at the revenue, just keep this in mind, around 565 crore of revenue, 61 crore of EBITDA, 11% of margins and 18 crore rupees of net profit after tax. There was no tax here at this point in FY25. So that's the other thing you want to keep in mind. Tax impact will start coming going into the 9-month period FY26. Let's look at those numbers now, and what you'll see is a sea change in terms of the numbers. You look at the growth that is getting clocked, 9-month FY26 versus 9-month FY25. These are the numbers. Still doing around 11% margin, even though there has been an uptick sequentially, and a profit after tax now of 143 crore. That's a 71x jump on a YOY basis, and therefore those numbers are not comparable. That's why we haven't given you the 3-year CAGR numbers when it comes to Raymond Realty. Let's talk about the margin trajectory, at least over the last maybe FY25 and thereafter for the 3 quarters. You never look at margins of real estate companies quarterly, but this will give you a sense as to what the range of the margins typically are, and therefore what the average margins turn out to be. It was 10.8% in FY25. Then we went into a range of maybe touching 13, and the lower end of the band 6.5. So you might land up at 11% margin even for 9-month FY26. That's essentially the indication, but that's the range. The goal here is to lift the margin from here to 20%. Can they do it is the question, and you'll have to obviously continue to monitor the company. We're not giving ratings for this company, viewers, because it's not fair. We don't have the quantum of data available, and we will speak with management and allow you to, of course, take a composed call on what you think that the numbers could look like in 2 to 3 years from now. Let's look at the balance sheet, and this will give you the understanding of where the company could go and whether it could grow in a healthy fashion or not. You look at equity, profit plus reserves, you'll get the book value of around 1343 crore odd. In terms of the borrowing number, it's at around 564 crore. This includes short-term borrowings as well. It has a cash position as well of around 210 odd crore at the end of H1 FY26. These are H1 FY26 numbers, by the way. There's a negative cash flow. Now, that doesn't look very pretty, and analysts do seem concerned about it. Questions were asked on the con call as well with regard to that negative cash flow. Cash flow from operations needs to turn positive. There will be a perspective which management will give as well when we speak with them today as to whether that is happening or not happening. Let's talk about the return ratios. Only 1 year again available, 16%. The aspiration is to get this to 20%. This is FY25 return ratios calculated. Let's look at shareholding pattern now. Now, here we could give a rating, but we haven't because this is the only metric where we could. A neutral on discount, if I were to give a rating, 49% owned by promoters FIIs, there's the likes of an ADIA, which is sitting in that FII basket. But ADIA has divested a bit of stake, so that is something you want to be mindful about. There's also certain DIIs, including some mutual funds, which have an interest, but a very small one, 4%, and the balance is owned by public, and then there is 1 or 2% held by IEPF and the like. So, which is the Investor Education and Promotion Fund. So that is broadly how the shareholding breakup currently stands. Now, to the key and important metrics. Let's talk about the development progress. And for that, we'll try and understand the current development, which is Thane. Around 1.3 million square feet is delivered out of the 5.8 million square feet under development in the 55 acres in Thane. That has a revenue potential of around 13,200 crore. Potential development within that Thane, which is 45 acres, is around 5.6 million square feet, which will add to another 11,800 crore of top line for the company. So that's the progress check with regard to Thane. Let's talk about joint development agreement, and here's where it starts to get interesting. You look at Bandra, 2,000 crore. This project is ongoing, but now you look at the new launches, because that's where the revenue is going to likely come from, and that's where the bullish stance of the management comes from as well. You look at BKC, you look at Sion Wadala, launch in Q4. BKC has been newly launched, and Mahim has 2 projects, 1+2. Expected launch is FY27. The combined amount of the launches here is 12,000 crore, and that is going to happen between Q3 of FY26, which is now, to the next year, which is FY27, Mahim 1+2. So you've got 12,000 crore of launches which are likely to come through, and all of that execution will likely pick up and begin in a very sharp fashion. Plus you have Bandra, which is ongoing. So that's something you want to keep your eye out on. What the management is guiding for: pre-sales growth of 20%, revenue growth of 20%, ROCE of 20%, and EBITDA margin as well, which is not there here, but that too is the aspirational EBITDA margin is 20%. Valuations on a trailing 12-month basis currently trades at around 20 times. If I were to hit that 20% growth number on a 2,000 crore top line, which they've clocked at the end, likely at the end of FY26 is what they'll clock, then that'll, and at a 12% margin, that will likely be a forward 16 times price to earnings. That's just the math I've done roughly. And now, let's obviously go and speak with management. We will bring on management in just a minute. What we'll do is slip into a very short break, come back, speak with the management of Raymond Realty. Welcome back. We're speaking about Raymond Realty, and we're going to be joined by, or rather we are joined by Mr. Harmohan Sani, who is the Managing Director and CEO at Raymond Realty. Mr. Sani, great speaking with you. Let me first start off by understanding that you've got a large pipeline of projects. How confident are you with regard to the launch pipeline that you have? Because you have the ambition of launching 5 to 6 projects over the next 6 to 9 months. How realistic is that?
Thank you very much for having me on the show. So as far as launches are concerned, Q4 is quite heavy for us in terms of launches, and it is indeed a very exciting time for the organization and the entire team. So in Q4, we have already launched 1 project in Wadala, because the Q4 has started from 1st of, so this month that launch has already happened. In the next month, we are launching 2 projects in Thana, and the preparatory work for all that has been done. We are just waiting for the last approval to move forward and do the launch over there. And then we will be launching the Sion project also somewhere towards the end of February or early part of March. So that's the launch pipeline for this year. And next year also the launch pipeline looks good out of the projects that we have already signed. So the 2 Mahim projects which we have, which is also a significant GDV, will be launched next year. So that's the launch pipeline, and we are completely on target as far as the launch schedules are concerned.
And what is the kind of traction you're expecting to receive from these launches? I'll come to the Thana project in just a minute because approvals have delayed that a bit. So I'll come to that. But just in general, talk to us about pricing and what's the kind of traction you're expecting to see.
So pricing in the last 3 years or 4 years, what we have seen in Thana primarily has been about 6 to 8% increase in pricing that we have got consistently. And I see that trend continuing going forward also. There doesn't seem to be any, let's say, headwind as far as the pricing is concerned. And it's a very healthy, steady growth which promotes good volumes, which promotes affordability, which continues. The incomes are currently growing at about similar rate as far as the economy is concerned. If you look at the numbers which the government has put out in terms of the growth for the country, and that's completely in line with that. And in fact, when you adjust it for inflation on a nominal basis, the country will probably grow at a much higher rate, 13, 14%. And compared to that, 6 to 8% growth in prices, I think is very, very healthy.
Agreed. Mr. Sani, what about approvals? Uh, you're not a new player in the market per se, but the kind of or the quantum of work you're doing has gone up dramatically over the last 6 years. Can you consistently get approvals in a timely fashion? For example, Thane has been a bit delayed. Uh, is that something of a feature that will likely drag the process for you at all?
Actually, if you ask me, there has been no delay in approvals. The government is very, very supportive for development. And if you have a genuine case and you honestly want to do business, the state government as well as the central government is very, very supportive. In Thana, there was definitely a slight delay which happened, but that was primarily because of the legal intervention, because there was this High Court order which prevented for MOEF approvals to be obtained for certain areas in the city of Bombay, which impacted the entire market. And naturally, we are not, removed from that. So we had roughly about a 2 month delay because of that when Supreme Court intervened and lifted that stay order. We have moved forward with our approvals, and the government is very, very supportive in terms of the delay which was caused by legal process also. So all approvals are moving at good pace, and we have not witnessed any kind of delay in any approval from any authority.
How does execution play out for you? Your goal is to do a 20% growth on the revenue front. Let's talk revenue. On the revenue front and on the pre-sales front. On the revenue front, you're doing close to 2,000 crore in terms of top line.
Right.
Will it be a linear 20% over the next 3 years, all the way through FY 28, 29, maybe?
Well, that's the endeavor to deliver that. And out of that, when I look at my projections and the numbers, given the current pipeline of launches that I have, so next 2 years growth is more or less locked in any case, given the launch pipeline that we have. And it's a very advanced pipeline in the sense that only two projects will remain to be launched next year, and rest everything is being launched this year itself, and that is sufficient to give me the 20% growth that we are targeting for the next 2 years. I currently we are working very hard on year 3, year 4, and year 5's growth in terms of business development and getting new contracts and getting approvals for those. But if you ask me, the visibility for the next 2 years, FY27 and FY28, is pretty clear as far as growth in pre-sales as well as the top line is concerned. I mean, we over the last 5 years that we've been in business, we have happy to share that we've gained a reputation for very fast execution, and because of that, whatever we sell enters our P&L also very quickly. Also, our time to market is one of the fastest in the industry. To give you an example, the Wadala project, which we have launched in January this year, we had signed on 31st March. We had done the definitive documents of that. So within 9 months, we were able to launch a project from start to finish, whereas the average time in the industry is about 2 years. So we may not be able to repeat that performance in every project, but that's our approach to the entire business. We are very, very focused on cash flows, IRRs, return on capital employed. We don't look at this as a land play business. For us, it's an operational efficiency business.
Get your point. So you'll be, if your numbers are to go by, you'll likely be at 2,900 crore in terms of top line by FY28. And where should your margins be in that case? And how should your cash flow evolve? Because those two are also critical drivers. You want your margins to drive up towards 20%. Where does your margin therefore lie? Where do your cash flows lie? Because your net cash flow negative at this point, free cash flow.
That's right. That's right. So the plan for that is very, very clear as far as we are concerned internally. So I'll try and communicate that to you in the clearest possible terms. So the last quarter, which we just finished, the December quarter, our EBITDA margins were 13%. For the 9 months ended 31st December also, EBITDA margins were 13% overall. And that's what we have disclosed in our investor presentation also. Those numbers are available for everybody to see. They are, uploaded on SEBI website as well as on our website. So anybody who wants to have a look can look at the granular detail also. And in Q4, we are launching some projects, and some projects out of that are high margin projects, because margin is always dependent on the product mix that you have at that point in time. So it varies a little bit quarter to quarter, but on an annual basis, we are able to, smoothen it out. So we will show a higher margin for the year. We will be closer in the range of 16 to 18% by the time this year ends. And next year, we will steadily march towards the 20% EBITDA margin profile. And the plan for that is already in place, and we've begun well. We have grown very, very rapidly, and that too a profitable growth, which is not easy to do. Typically, when companies grow fast, they have to sacrifice profitability. And we started from zero. We were new in the business, and we've steadily shown profitable growth for the first 5 years. When not even a single year we've shown a dip, and the growth has been pretty good. Our CAGR, if you see over the last 5 years, has been quite impressive, even though I'm saying it, but still, I mean, I've been in the industry long enough to actually make that comment.
Sure. Sure. No, point taken, Mr. Sani. Thank you so much for coming in and speaking with us. If you do achieve that 20% guidance, the numbers will go out of whack. It'll be hockey stick. And viewers will understand that, because we've put up the numbers on the screen. At 11% margin, your FY25 numbers at nearly 600 crore top line, 11% margin, you're at 60 crore of EBITDA. At 2,800 crore top line, at a 20% margin, the EBITDA will be 10x in 3 years. So the numbers will look extremely different. Now, of course, that's the guidance coming through. Execution likely to follow. But hopefully this has been productive for you. Out of time on this edition of All About Your Company. Stay with us here on ET Now. More action to follow.